Your next reading is capital budgeting. First, a quick overview. Hopefully, we'll have a quick overview and then we'll go straight to the questions. These are the specific learning outcome statements and we'll briefly discuss these all. First, describe the capital budgeting process and distinguish among the various categories of capital projects. What is capital budgeting? Capital budgeting involves investing in long-term projects that have multiple years into the future. A long-term project that affect many years into the future. They affect your balance sheet in the form of assets. They affect your income statement through depreciation. They affect your cash flows in the form of investing outflows in the year in which the investment is being made. So capital budgeting involves a process of decision making on large long-term projects that have many years duration to complete and deliver. Categories of capital budgeting. Replacement projects. We may have to replace certain machines, certain facilities in order to expand our, not expand, just replace. Machine X is being replaced with Y. So this involves less risk. But if the replacement involves increasing efficiency, then it requires some deeper analysis, so that, because see, capital budgeting involves large sums of money. You cannot invest such money without proper analysis. So you have to take into account the minute details and the variables that can influence your decision. Next type of capital project are expansion projects. By nature, replacement is less risky, but increasing your productive capacity, it could involve more risk, hence more careful analysis is needed. New product and services, this is even more riskier. It involves more uncertainty. So it's going to be more detailed, more data might be needed to make the appropriate and right decision. Then fourth type of capital project could be regulatory, safety and environmental projects. Maybe the government has, under the law, required firms to use certain type of machinery, that is what you call the green technology. Right? So such investments may not generate some revenue, but they will involve sizable outflows. And finally, some other projects. There might be many other projects, expanding a new product line, entering new geographical region, etc. and etc. Next said, what are the steps involved in capital budgeting? The first step is considering ideas. Where do we need to invest? Where do we need to expand? When do we need to buy new machinery, replacement machinery, or a machinery with more efficiency? So ideas can come from anywhere. It could come from the senior management through implementation downward, or the idea could originate from the bottom of the organization, the lower level management. They might give their recommendation to the senior management for capital investment purpose. Second stage is analyzing individual proposals. We may have shortlisted maybe 4 projects A, B, C, D. We will forecast cash flows for each project separately, expected cash flows each year, initial investment. So A, B, C, they will all be analyzed separately, cash flows related to each project, and then we will evaluate their profitability using various techniques that we'll study today: net present value, IRR, payback period, discounted payback period. So using these tools, then we will make decision. Once it is done, the next step is planning the capital budget. Out of these ABC, which one do we select? Consider the profitable proposal within the company's overall strategy, the one that is aligned with our objectives, the one that is most suitable in a given circumstances. And the last step is monitoring and post-auditing. Once the project has been undertaken, investment made, implemented, and not working, wait for some time. Let's say the project has a life of 10 years. We want to assess whether the intended objectives have been achieved Please do not do that in second or third year. It's too early. Do not do that in the 7th or 8th year. Post audit is done once all the cash flows are known with certainty. Then we will make a comparison versus what we were estimating under the capital budget and what are the actual results in total over the 10 years. Such post audit will assist us in taking care in the future. Managers will mostly paint rosy pictures. They will offer projects A, B, and all look attractive. Eventually, when the actual action starts, the projects may not deliver the way they were painted, the way they were projected. So such an analysis, such an audit is essential. It will deter the managers from proposing or overestimating the viability of certain projects. That's why this last stage is important, post-auditing. Then your next two LOSs are describe the basic principles of capital budgeting, explain how the evaluation and selection of capital projects is affected by mutually exclusive projects, project sequencing, and capital rationing. First of all, some basic ideas. In cash flows, in NPVs and IRR capital budgeting processes, we consider cash flows, not accounting profits. It's accounting profits. Why? Because accounting profits are heavily influenced by accounting conventions, by accounting standards, by reporting requirements. We need cash flows for the purpose of assessing the viability of projects. Timing of cash flows is very important. $1,000 received at the end of year 1 versus $1,000 received at the end of year 8. This is much more valuable for the firm. The cash received is more valuable if it is received as early as possible during the life of the project. The cash flow inflow that is far away from the current time period, it will have less present value in the present terms. So timing of cash flows is important. The sooner you receive the cash, the better. Remember, we will only consider the incremental cash flows. Right now, our revenue is $100,000. If you take on a project, our revenue goes up to $110,000. So we will only consider the incremental revenues. Our existing cost is $80,000, and after taking on the project, our cost goes up to $85,000. So only the incremental cost and incremental revenue are relevant for the decision-making process in capital budgeting. There are two absolutes in the world, death and taxes. You can't avoid these. So impact of taxes cannot be ignored. Wherever there is a tax impact, it must be considered. Your cash flows must be taken after tax. Any gain or disposal on the replacement of assets should be taken after tax. So wherever the tax is involved, the tax impact must be considered in the capital budgeting process. Finance cost. Finance cost, whether the money has come by issuing bonds, whether we have issued shares, the financing cost, the cost of funds, whether they are from share issue or the bonds, they are ignored. Financing costs are ignored in cash flows. Why? Because this cost of fund is embedded in our rate that we use to discount the projects. We use a certain rate for discounting purposes. We might have studied in discounting and compounding in your statistics. So in discounting, when we use a certain rate, the cost is already embedded in it. So we don't need to take it separately. Your capital budget considers cash flows only. Cash flows differ from net income. Why? Because your net income might include certain non-cash charges like depreciation, like amortization of bond discount and loss on disposals, certain non-cash gains and loss recognized in income. So since net income includes many non-cash charges, so it is different from cash flow. So in capital budgeting process, we consider cash flows only. Then some important concepts that we need to remember while doing cash flow related questions. Sunk cost is a cost that has already been paid, gone. The cost that is paid is gone. it is irrelevant, ignored in the decision making, is ignored in capital budgeting. If it is paid, sunk cost. If it is contractually obligated, you are contractually obligated to pay. You can't ignore the payment, you can't revoke the payment. If the cost has been paid or you're contractually obligated to pay, it's a sunk cost. Sunk cost is not always the one that has been paid. The cost that you are under the law contractually bound to pay, it's a sunk cost as well. Remember. So sunk cost is the cost that is either paid or you are contractually bound to pay. Opportunity cost, I'm sure you have the idea. Let's say I have a piece of machinery and it can be sold right now for $10,000. Instead, I use this in a certain project and I give up this $10,000, which I could have earned or could have received by selling this machine. So when I analyze or when I do my computations for investment appraisals, this $10,000 that has been sacrificed for this specific project, it must be considered as a cost, because for this project, project X, I had to give up this $10,000. So this will be considered as my opportunity cost, right? So the benefit that has been given up for a certain decision, that given up benefit is considered as a cost in investment decisions. Absolutely. So research and development cost that has been paid is a sunk cost. Correct. Incremental cost, cash flows, as I said, that we will only consider incremental cash flows. The cash flows, cash revenues and cash costs which are already being received and paid are not relevant. We will only take the cash that is additional cash inflows, additional cash outflows. They are relevant and must be considered. Externality. Your project involves some effects outside the project's domain. These external influences could be positive, could be negative. They must be considered as well. So externality means certain effects of your investment on other things beside the investment itself. Those other influences, they can be positive, they can be negative. They are called externalities. Just like when you install a machinery, the fumes that are generated and extracted into the outside environment, they create negative externalities, pollution. But you also create jobs, more products, more choices for the consumer. That is positive externality. So any investment decision involves certain externalities, positive and negative as well. Cannibalization. Adam Khor, man eating man. That's the word, origin of the word, cannibalization. How is it involved here in the capital budgeting? If you take on a certain project, it might eat away your revenues from other projects. For example, let's take my example. We are training CMA and CIE students, right? We get with certain revenue stream from these service lines. If we start CFA, we might sacrifice on some revenues from this revenue stream because they might move to CFA. So because of a certain decision in capital budgeting, your existing products, your services might stand to lose something because of this new project. This is called cannibalization, right? When an investment takes on customers from other products or services that you're selling, this is called cannibalization. Conventional versus unconventional cash flows. Conventional cash flows are normally the initial investment is made at year 0, and then you receive regular cash flows in year 1, 2, 3, 4 as a plus sign. These are called the conventional cash flows. Outflow at the start, inflow till the end of the project. But certain projects might have unconventional cash flows or non-conventional cash flows. What does it mean? That initially you have to invest this much. You will receive sizable cash in year 1 and 2. Again, there is an outflow of $50,000, maybe additional working capital investment. Again inflow, and then it might involve again some investment at this particular year. This is called non-conventional or unconventional cash flows, that the cash flow is changing its direction plus negative, right? So we might come across both of these types of cash flows in our calculations. Independent versus mutually exclusive projects. Independent projects means you have project A, project B, project C, and all of these can be taken simultaneously. These are independent projects. All of these can be taken on simultaneously. Mutually exclusive means if you take A, you can't take B. If you take B, you can't take A. Only one of these, either A or B or C. This is called mutually exclusive projects. Just one of these can be taken. Whereas independent means we can take A and B and C together. If you have sufficient money, if there is no capital rationing, you can take on all of these projects. Then project sequencing. Project sequencing means investing in certain projects that will generate options to invest in some new projects. Like initially we started CIA, we succeeded. That gave us confidence to start CMA, and we are now at the moment in Pakistan, we are the most dominant, most powerful, most resourceful institute of CMA training. Largest number of qualified CMA in FTC. This number is bigger than all the CMAs added together in Pakistan. And this has given us the push to dominate in CFA in the next 3 to 4 years in the future. That's project sequencing. If you succeed in one thing, that will open new opportunities for others and as well for the next projects. This is project sequencing. Investing in one project will generate more options to invest in the future project. Capital rationing versus unlimited funds. Capital rationing means that we have limited funds and we cannot take on all projects. We have limited funds. We can invest only in A or B. So for that we have to make sure that we make most use out of the funds, maximum NPV per dollar of investment. So when there is limited capital available, we have to select amongst the projects using profitability index we'll discuss. But when the funds are unlimited, take on all the projects that have positive NPV. All the projects that are generating positive NPV and they're independent, take them all. Next, calculate and interpret net present value, internal rate of return, payback period, discounted payback period, profitability index of a single capital project, assuming the required rate of return is 8. This is the LOS and I have converted into a question. Let us take this as an example. This is your project that involves 50,000 initial investment. Then these are your inflows in year 1, 2, 3, 4 and 5. We will calculate NPV, we will calculate IRR, we will calculate payback, discounted payback as well as profitability index for this project. How we'll do it? Okay. So this is your initial investment, $50,000 negative. This is your cash flow to year 0, 50,000 negative. Enter down arrow key. Now there are two cash flows in year 1 and year 2, $15,000 each. You will write 15,000. Enter down arrow key. Since the frequency of 15,000 is 2, you will write 2, press 2, enter down arrow key. Now the third cash flow, which is CO2 here, is 20,000, this one. So you're going to write 20,000, type in 20,000, enter, down arrow key once and twice, because this cash flow is once only. Then you have 10,000 in year 4, you write 10, enter, down arrow key twice. Then 5,000, enter, down arrow key twice. Now you need to calculate NPV, press NPV. The system will ask what is the discount rate, 8%. 8, enter, down arrow key, press CPT. Now this is your NPV. This is your NPV 3,378,000. 3,378, right? If you press IRR and press CPT, this is your IRR, 10.879. Your calculator will do, just need to plug in the numbers. It will do it itself. So IRR is calculated. We need to calculate the payback. So computation of simple payback is very simple. You have negative 50,000 to recover. You have recovered 15,000 in year 1, 15 in year 2, total of 30, and 20 in year 3. So it means total 50,000 has been recovered. by the end of third year means your conventional payback period is 3. Payback period is the time that it takes to recover your initial investment, right? NPV that the calculator calculated, it's equal to the present value of your inflows minus initial investment. Sometimes initial investment is required or given, or you can say the present value of outflow. So basically, NPV is equal to your present value of inflows minus present value of outflows. If you compare your inflows and outflows in the present term, the difference between these is called NPV. If NPV is positive, it means your project is generating more than 8%. If NPV is negative, it means project is generating less than 8%. If the NPV is 0, it means your project is generating exactly 8%. That's what you call NPV. Positive NPV is desirable. Okay. IRR, on the other hand, is that discount rate, that specific rate at which NPV is equal to 0. Internal rate of return is a rate of return at which the present value of inflows and present value of outflows are equal. In that case, your NPV would be 0. Payback is the time that it takes a project to pay the initial investment back. This 50,000 was recovered within 3 years, so the payback, conventional payback is 3 years. Now, let's say if the cash flow here was just $10,000, or let's say just $15,000, which means 15 plus 15, 50. We have covered $45,000. Still $5,000 needs to be covered. This $5,000 will be recovered or covered from the 4th year cash flow. So the payback period is 3 years plus some partial fraction of the year. How we will calculate that? The remaining cash flow to be covered, 5,000 divided by 10,000 in year 4, it gave you 0.5. So basically it will be 3.5 years. Whenever the cash flows do not cover the complete period, initial investment in a particular year, so whatever is required is to be taken from the next year this way. Cash flow needed to recover divided by the total cash flow in that particular year, it will give you the fractional part of the payback period. Add these two, you will get your payback period. The discounted payback period involves discounting these cash flows in the present terms. All these must be converted into present value. This can be converted by dividing it with 1.08, 15,000 divided by 1.08 square, 20,000 divided by 1.08 square, a cube, and so on. All these cash flows can be converted into their present terms. You're using your simple calculator, BA plus 2. And then you can see that at which time has your initial investment been recovered. This is called the discounted payback period. So Arslan has calculated perfectly. Payback period is straightforward, 3 years. Discounted payback period, that involves discounting these cash flows, and from these discounted numbers we have to recover 50. It is 4.007. So you take 3 years to recover your cash flows. On the discounted basis, you take 4.007 years to recover your initial investment. And profitability index is used when you are facing constraints, when there is capital rationing. You have limited amount of money available. Just like those who have studied CMA, we study constraints in our production because of less material, because of less number of machine hours or labor hours. So what we do, we try to maximize our contribution per machine hour or per labor hour. Contribution per machine hour is to be maximized. We use the same idea here. Profitability index is equal to NPV divided by initial investment. A project that is generating NPV of $10,000 requiring an initial investment of $100,000, it means this project is generating $0.1 for every $1 of initial investment. Any other project that generates more than 0.1, let's say $0.35 per initial dollar 1%, that project will be more desirable. So profitability index is used when we have limited capital available, and we use this criteria, NPV upon initial investment, to decide upon which project should we take. Higher the number NPV per initial investment, the more desirable that project would be. There is a little variation in this formula. Sometimes profitability index can be calculated by dividing the present value of inflows upon initial investment, or sometimes NPV upon initial investment, or you can just memorize this way. Profitability index is equal to 1 plus NPV upon initial investment. Either it is used this way or this way. NPV upon initial investment. The higher, the better. All right, next. Explain the NPV profile. Compare the NPV and IRR methods when evaluating independent and mutually exclusive projects, and describe the problems associated with each of the evaluation methods. This is the NPV profile. If the discount rate is 0, for example, so this is the NPV that we can generate from project B. As the discount rate is increased, we know the discount rate, when it is increased, the NPV falls. We raise the discount rate up to 5%, NPV fell. 10 fell again. As we kept increasing the discount rate, the NPV continued falling. The point came when the discount rate was used 15%, NPV turned 0. The rate at which the NPV becomes 0, that rate is called the internal rate of return. So you can see this line shows the cost of capital, 5, 10, 15%. This line shows NPV, positive and negative. So when there is no cost of capital, which is not possible practically, these are the NPVs. As we increase the discount rate, NPV falls. So at this point, when the NPV is 0, this would represent the IRR of project B. That is about maybe 12%. And at this rate, 15%, the NPV of project A becomes 0. So this is the IRR for project A. This is the IRR for project B, because IRR is that rate at which the NPV is 0. So this is what you call the NPV profile, that how the NPV changes with the changes in discount rates. The point where these two projects are rate, where these two projects generate same NPV, it's called the crossover rate. Rate at which the projects give the same NPV, that rate is called the crossover rate. So this is called the NPV profile. The difference between independent and mutually exclusive project has already been discussed. Independent projects mean those projects that can be taken simultaneously if you have no capital constraints, no capital rationing. Mutually exclusive projects means either A or B or C. They can't be taken simultaneously because they are of such nature. Projects, if they are independent, if you use NPV as an evaluation criteria or IRR, independent projects, NPV and IRR, they give the same accept, reject decision. If the projects are independent, either use NPV or IRR, they are on the same page. They might disagree, they might give conflicting conclusions or recommendations if the projects are mutually exclusive. One, not the other. NPV and IRR might be in conflict, and when they are, always choose NPV. Whenever NPV and IRR are in a conflict, you should always choose NPV. It's the most sophisticated method. So NPV is the best tool. That is positive. It measures absolute increase in the shareholders' wealth in dollar amounts. What is its weakness? It ignores size of the project. Why? Because it gives you only the NPV that might be $1,000. Like in the previous case, you calculated correctly, Aslan. The previous question, when we calculated NPV, it was 3,378. This NPV doesn't tell us what was the initial investment. It just gives you the difference between present value of inflows and outflows, right? That's the drawback. The number itself doesn't take care of the initial investment. Even it is calculated using the initial investment, but ignores the size of the project. And the problem with the internal rate of return is that if the cash flows are unconventional, non-conventional, they are changing sign, positive to negative, positive, positive, negative. So when the signs of the cash flow changes, there will be as many IRRs as there are changes in the cash flows direction, right? So IRR also might be in conflict with NPV. The good thing about IRR is a simple percentage that is easy to understand. Otherwise, it might be in conflict with NPV. We should go for NPV then. And the problem with IRR is that for unconventional, non-conventional cash flows, there will be more than one IRR. So which one of that is correct? That is sometimes confusing. So that is your LOS 5. 6 is contrast the NPV decision rule to IRR decision rule and identify problem associated with the internal rate of return rule. Pitfalls of IRR. IRR used in isolation is seldom the best route. That's why it's not the best, right? So you should use NPV and IRR. IRR alone in isolation is rarely the best route to sound capital budgeting decision. Why? Direction of cash flows. When the direction of cash flows changes, focusing simply on IRR can be misleading. Like in this example, we have two projects, project X that requires initial investment, cash will come in period 1, and the project Y that requires that will involve initial receipt of 222, and then you need to invest later. Very different dynamics here. This is normally the case. You first invest, then you receive. But there is a project that is giving you inflows first, outflows later. So these are very unusual projects, unconventional, non-conventional cash flows. So if you use IRR criteria, the IRR for both of these projects, if you calculate using your financial calculator, it's 8%. Since IRR is same, and if you rely solely on IRR, you will say, why not Y? Why not Y? Why? Because it's a front load. I mean, the project that is generating inflow first, outflow later. Every one of you, including me, will go for this project if you rely on IRR alone, because this project is generating this amount at the start and you have to pay later, and IRR is 8%. So you definitely go for Y. Now the problem with this is that we have ignored NPV. If we calculate NPV for these two projects, you will know the project X has a positive NPV of 4193 and project Y has basically a negative NPV. So the project that looked good because it was a non-conventional one where the cash flow was coming in year 0 rather than in the first or second year, we preferred Y, but in fact this is not the right choice. So NPV has highlighted the difference, and quite a glaring difference. Means X project is more viable. This effect is known as multiple IRR problem. Essentially, there are as many solutions to the IRR formula as there are changes in direction of cash flows. So if the cash flow changes direction in 3 times in the life of the project, there will be 3 IRRs. If the cash flow changes direction twice, there will be 2 IRRs. This is called the multiple IRR problem. That's the weakness of IRR. That's what we're discussing. Problem associated with the IRR. Again, as I said, independent projects will, for NPV and IRR, they will give same accept reject decision. But mutually exclusive projects, IRR and NPV may be in conflict. As with the changing cash flows, focusing only on IRR when the capital is limited can lead to unsound decisions. Like in this case, project S involves this much initial investment and this cash will come. Project T involves this is initial investment, 330 will come, so the net cash. So IRR is 12% for project S and 10% for project T. So if you solely rely on IRR, you will go for project S because it is higher. It's look good, 2% higher. Moreover, it involves less investment. But if calculated on NPV basis, now look at this. For project S, NPV is 10,108 and project T, which you rejected, albeit little higher, but still NPV is more. It's the NPV that increases the value of the firm. It's the NPV that increases the share price. So it means we would have made a wrong decision by taking on project S just because it has 12% IRR. In fact, the project that is more desirable is the one that gives more NPV. Since it's a mutually exclusive one, either we go for S or T, so we will go for the one that generates more NPV. So that would have been project T, not S. Here IRR has also put you in trouble. I think it's an example I've extracted from CMA. I think it's 6% maybe. Try with the 6% number. See, so while project S has the distinction of giving the company higher IRR, but project T is in fact a preferable one because it adds more shareholder value. So that's the problem with IRR, varying rates of return. A project NPV can easily be determined using different rates of return. For example, I have a project that might face great risk in year 1 to year 3, and the risk will stabilize for year 4, 5, 6. So I might use a higher discount rate in year 1 to 3, maybe 15%. And I can use the lower discount rate, maybe 8% in the later years. This is something that you can do with NPV, but not IRR. So varying rates, a project NPV can be easily determined using different desired rates of return for the project for different periods. But unfortunately, no such facility for IRR. The IRR is limited to a single summary rate of entire project. We can't do that with IRR. Another major advantage of NPV is that if I have 3 projects A, B, and C, NPV of project A is 10, 15, and let's say 15 again. These NPVs can be added, giving you a total $40,000 NPV of all these projects. But if their IRR is, if let's say 18%, 10%, and 12%, IRRs cannot be added. So NPV amounts from different projects can be added, but IRR rates cannot be. IRR for the whole is not the sum of IRRs for the part, whereas the NPV for the whole is the sum of the NPVs of the individual projects. Finally, describe expected relationship among an investment's NPV and the company's value and the share price. As we have agreed, NPV is the direct measure of expected change in the firm's value. If a project has a positive NPV and the company takes on that project, it will add to the value of the firm. Since the value of the firm goes up, the share price will go up as well. NPV is linked with share price. Positive NPV will increase the share price. If the NPV is negative, the value of the firm will fall, so it will result in decreasing the share price. So basically, your share price, it is the function of your future earnings. If your NPV is higher, that means your earnings are expected to be higher. Higher earnings will feed into your share price, the share price should go up. That's how they are related. And if NPV is negative, that means earning will be lower, so it will lower the share price now. So gentlemen, that completes your reading capital budgeting.